Every week, two stocks hit new lows for reasons that aren't always obvious. In this series, we break down what's behind those moves so you understand what's actually driving the market. In this week's list, it's tiny. There are barely any losers, which usually means the market's still pretty strong. So when something does fall to a new low in a bullish market, that's when you stop and take a closer look. There's no big theme connecting the losers this time, but two names jump out. One riding the obesity drug boom and the other running an auto salvage auction house. Completely different businesses, completely different problems, but both have something to teach us about how to read the market. So let's jump in. First up, Novo Nordisk, the obesity drug giant, suddenly under pressure. Novo Nordisk basically kicked off the whole obesity drug boom with Ozempic and Wegovy. But now the story's flipped. US growth has slowed and they've had to cut prices to stay competitive. And yet, Eli Lilly is still eating into their market share. And on top of that, compounded GLP-1s are undercutting Novo's prices across the board. Novo cut sales guidance, which spooked investors. They've also had a CEO change and ongoing supply issues for Wegovy and Ozempic. Small problems, but they pile up. At the same time, they're restructuring the business. They're cutting 9,000 jobs to focus entirely on obesity and diabetes. They're also doing acquisitions to shore up the pipeline. That's a bold plan, but it puts them in direct competition with Eli Lilly. So right now, Novo looks like a giant under pressure. They're still massive internationally and have a decent obesity drug portfolio, but they're in a rough patch while they restructure and defend market share. The stock is beaten down due to strong competition from Eli Lilly, but this could also be a buying opportunity, especially if their next generation drugs deliver. Let's dive into the financials and investigate further. Novo is still growing, just not at the 30% annual rate they used to hit. Sales are up 17% year over year, which sounds good, until you realize Eli Lilly is growing at 45%. Lilly's obesity drug sales are surging and stealing market share. Novo has had to cut prices to stay competitive, and that's hitting revenue growth. We've seen this pattern a lot on the channel with medical companies. We looked at Teva yesterday, and they had similar issues. A common theme is one-time charges that end up being recurring. You can usually check this by comparing adjusted EPS to GAAP EPS. In Novo's case, there isn't a huge adjustment yet. That could change soon. Novo made a big acquisition in 2024 with Catalent. They're also planning to cut 9,000 jobs in a restructure, and they're trying to acquire Metsera to expand their obesity portfolio. If you're analyzing Novo in the future, it'll be key to decide if these supposed one-time charges might continue. Looking at geography, Novo's obesity care segment is still growing fast internationally, about 40%. But US growth is sluggish. That raises an important question. Is this an issue with the drug itself, or is Eli Lilly just dominating the US market? The historical financials look strong, but the future is very uncertain. Will Novo's sales keep declining because of fierce Eli Lilly competition, or will their new pipeline reaccelerate growth? Moving on to valuation, almost all of Novo's free cash flow gets returned to shareholders through dividends and buybacks. That's around $10 billion, giving a 4.6% yield. Given the slowing growth, let's be conservative and forecast a slowdown from the current 17% year over year to about 10%. Combine that with the yield, and you're looking at a roughly 14.6% total growth. If we plug that into our valuation model, and keep the forward PE at 12.6, the potential 5-year return is about 98%. That's not bad at all. Even if Novo is second place to Eli Lilly in the obesity market, at the right valuation, it can still be a solid opportunity. I'm just not convinced we're there yet. The major risk is a continued slowdown caused by the competition. We're not scientists or biologists. Without that expertise, it's important to be cautious when forecasting these pharma companies, especially when looking at their pipeline. If growth were to slow to a combined total 10.6% and the forward PE were to drop to 10, the projected 5-year return drops to 31%. far below the market rate of return. Novo is already down 50% this year. The lesson? Even a huge growth stock can stumble hard when stronger competition shows up, a fear that many have for today's market leaders. Now, let's check out Copart, an auto salvage company that's quietly sitting on a massive cash pile. Copart is the backbone of the global salvage vehicle auction market. They connect insurance companies, banks, and rental car fleets with buyers around the world, turning total cars into cash. Basically, if a car is declared a total loss by your insurance, Copart is where it ends up. Copart's revenues have been driven by rising total loss frequency. Today, over 22% of vehicles are being written off, up from just 4% in the 1990s. Modern cars are loaded with sensors and advanced tech, so even minor collisions can be expensive to repair. This pushes insurers to declare them total losses. That's great for Copart because more total losses mean more vehicles to auction. And it's not just a US story. International buyers often repair these total losses under different standards, giving cars that would be too expensive to fix a new life. Copart consistently hits all-time high auction prices, keeping profitability strong and clients happy. In short, Copart is a market leader benefiting from growing vehicle complexity, rising total loss economics, and global demand. But what makes Copart even more interesting? Their $5 billion cash pile. Copart's financials are solid. Trailing revenue sits at $4.7 billion, up 7% year over year. Growth is slowing and analysts are concerned, but Copart management says this is temporary. Looking at the long-term chart, growth fluctuations are normal. Growth averages a healthy 12.7%. Even more impressive is net income, which grew 14.6% year over year and has averaged around 18% over the long term. This comes from steady improvements in both EBITDA and net income margins. And then there's the cash. Copart is sitting on $5 billion of cash with zero debt. That's huge flexibility. But don't get too excited. Copart doesn't pay a dividend and buybacks are rare. They usually return just a few $100 million when the stock is deeply discounted. Most of the cash sits idle for potential M&A, which is great strategically, but it drags on long-term stock performance. If they return it to shareholders faster, the stock could even be stronger. Normally, people adjust Copart's valuation for the $5 billion in cash, but the company has zero intention of returning that to shareholders. There's no dividend and buybacks are rare and small. So that adjustment is misleading. The stock's value comes purely from growth and the multiple. Being conservative, I'd forecast 13% net income growth versus the 15% they've been reporting. But the multiple still feels high, likely reflecting the post-2020 car market euphoria. I'd peg it closer to 20, which gives it a roughly 58% return over 5 years. My take, the biggest risk is multiple contraction. Add in the fact that investors will see almost no cash returned, and this one's a hard pass for me. Copart has other risks as well, but the biggest one, nobody is talking about it. Electric cars are taking off. They're expensive to repair, which should actually boost total loss auctions. But if self-driving cars take off, it could completely change the economics of Copart's business. Copart is a great company that shoots itself in the foot as an investment. By not returning cash to shareholders, a potential market-beating 17% total return turns into a market underperforming 13% total return. So what's the takeaway? Novo Nordisk shows what happens when high-growth, high-PE companies face competition. Even massive growth leaders can stumble, something investors worry about for companies like NVIDIA. Copart shows that a great business doesn't automatically make a great investment. How management deploys profits, known as capital allocation, matters just as much as operational performance. The lessons? Growth is never guaranteed. Always watch fundamentals, understand the risks, and pay attention to how management allocates capital. That's what separates smart investors from Wall Street bets YOLOers. If you found this helpful, hit like. And since you stuck around this long, join me on Discord. Link in the description. I'd love to help you on your investment journey. Thanks. Bye.